Checking account. A checking account is designed for daily transactions and immediate access to your money. It allows you to deposit and withdraw funds easily, often through checks, debit cards, or electronic transfers. Historically, checking accounts became popular as banking expanded in the 20th century, providing a safe alternative to carrying cash. They typically offer low or no interest, but their convenience for paying bills and receiving deposits makes them a cornerstone of personal finance. Many people use checking accounts as their primary hub for money coming in and going out. Savings account. A savings account is meant for storing money over time while earning interest. Unlike checking accounts, they limit the number of withdrawals and often have higher interest rates, rewarding people who keep funds untouched. Savings accounts trace back to the early 19th century when banks began encouraging individuals to save. They differ from checking accounts by focusing on growth rather than spending, helping account holders build a financial cushion and manage future expenses safely. Money market account. A money market account blends features of both checking and savings accounts. It often offers higher interest rates and limited check writing capabilities. Originating in the mid-20th century as banks sought alternatives to traditional savings, money market accounts appealed to those who want better returns without sacrificing liquidity. They usually require higher minimum balances but provide the flexibility to access funds relatively easily while benefiting from competitive interest rates. Certificate of deposit. A certificate of deposit, or CD, is a time-bound deposit where money is locked in for a set period in exchange for higher interest. The concept dates back centuries, but modern CDs gained prominence in the 20th century as banks sought stable funding sources. They differ from regular savings by imposing fixed terms and penalties for early withdrawal, encouraging long-term saving. CDs are valuable for people looking to grow their funds predictably without exposure to market risk. Individual retirement account. An individual retirement account, or IRA, is designed to help individuals save for retirement with tax advantages. IRAs became widespread in the late 20th century as governments promoted personal retirement savings alongside pensions. They come in different forms, such as traditional and Roth, each with unique tax treatments. Unlike standard savings, IRAs focus on long-term growth and retirement planning, making them an essential tool for financial security in later life. Joint account. A joint account is shared between two or more people, commonly used by couples or business partners. It allows all holders equal access to deposits and withdrawals. Joint accounts have existed for decades as a convenient way to manage shared expenses or investments. They differ from individual accounts by combining funds and responsibilities, making them useful for household budgeting or collaborative financial planning, though they require trust and clear communication among account holders. Business checking account. A business checking account is tailored for companies rather than individuals. It supports higher transaction volumes, merchant services, and payroll management. Business accounts evolved alongside commerce as small and large businesses needed a separate system for finances. They differ from personal accounts by offering tools for tracking income, expenses, and tax obligations, helping business owners manage cash flow efficiently and professionally. Student account. A student account is a type of checking or savings account designed for young adults in school. These accounts often have low or no fees and may offer perks like debit cards and online banking. They became common in the late 20th century to encourage financial literacy among students. Student accounts differ from standard accounts through features that accommodate limited income and promote responsible money habits during early adulthood. High-yield savings account. A high-yield savings account is a type of savings account that offers interest rates significantly above the national average. Often offered by online banks, these accounts emerged as digital banking allowed institutions to cut overhead and pass savings to customers. They differ from traditional savings by focusing on maximizing returns while still maintaining liquidity. High-yield savings accounts are ideal for individuals looking to grow their emergency funds faster without risking capital. Trust account. A trust account is set up to manage money on behalf of another person or entity, often under legal guidance. Trust accounts have a long history in estate planning and wealth management, ensuring funds are used according to specific instructions. They differ from personal accounts because the account holder acts as a trustee rather than the direct owner, providing control and protection over assets for minors, beneficiaries, or charitable purposes. Health savings account. A health savings account, or HSA, is designed to help individuals save for medical expenses with tax benefits. Introduced in the early 2000s in conjunction with high-deductible health plans, HSAs allow pre-tax contributions and tax-free withdrawals for qualified expenses. They differ from other savings by focusing solely on healthcare costs, offering a combination of flexibility, tax efficiency, and personal control over medical spending. Online-only account. An online-only account operates entirely through digital platforms without physical branches. These accounts became more prevalent in the 21st century as internet banking grew. They differ from traditional accounts by offering higher interest rates, lower fees, and convenient 24/7 access while foregoing in-person services. Online-only accounts suit tech-savvy individuals comfortable managing money entirely through apps and websites. Payroll account. A payroll account is used by employers to distribute salaries to employees. It streamlines payroll processing and direct deposit, ensuring timely payment. Payroll accounts developed alongside modern employment structures requiring efficient wage management. They differ from personal accounts because their primary function is administrative, not individual savings or spending, simplifying financial operations for businesses and workers alike. Custodial account. A custodial account is managed by an adult on behalf of a minor until they reach legal age. These accounts have been used for generations to teach financial responsibility while legally protecting assets. They differ from joint or personal accounts by placing control with the custodian, ensuring the funds are used appropriately for the minor's benefit. Custodial accounts are important for long-term savings, education funds, and early financial education. Holiday Club account. A holiday club account is a type of savings account designed to set aside money for seasonal expenses like vacations or gifts. Popularized in the mid-20th century, these accounts encouraged regular saving toward predictable events. They differ from standard savings by structuring deposits for a specific goal, often with automatic transfers or incentives. Holiday club accounts help individuals plan ahead and avoid financial stress during peak spending periods. Foreign currency account. A foreign currency account allows deposits in a currency other than the local one. These accounts arose with globalization and international business needs, providing flexibility for travelers and multinational operations. They differ from domestic accounts by managing exchange rates and currency risk while enabling international transactions. Foreign currency accounts are valuable for people who work abroad, invest internationally, or travel frequently, offering convenience and strategic financial management. Thanks for watching. If you found this video helpful, make sure to subscribe so you don't miss the next ones. Drop a like. It really helps the channel grow. And leave a comment below telling me what you want to see next. See you in the next video.